Good morning and welcome to this Monday, November 15th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, we're getting off to another decent start. Futures, at least as of just a few minutes ago, we're looking pretty good. Let's see what we've got here. This was probably about 10 minutes ago when I looked, but Dow futures up 140 points, S&P 16, NASDAQ up 70. So somewhere in that 0.35% to 0.45% range across the board. So it looks like we're getting off to a pretty good start there. Crude oil has dropped a little more than 1%. Currently, it's down under $80 a barrel. So seems like it's been holding mostly above 80 of late. So that'll be something to watch as we move into the early part of the week. Of course, energy been struggling a little bit of late after leading the market. And it looks to me like it's trying to roll back over again. So crude oil prices could have a big impact on that. So we'll want to keep an eye on that. The 10-year Treasury yield, which I'll get into a little bit, relatively flat. It opened a little bit lower, but coming back. We do have a number of economic reports out this week, so we'll be talking about that. Probably the best news of all is there's no inflation reports out this week, so we got those out of the way from last week. So hopefully the market can move back beyond that. Even with a very hot report, the CPI last week was much hotter than expected. The S&P 500 closed almost essentially where it closed the prior week. It was down just a fraction. So the market is ignoring it. And as long as the market continues to ignore it and we're not really seeing major inflationary impacts on the charts, then I would tend to ignore most of what you hear about inflation, instead believing the Fed, which is that it's going to be a temporary thing. All right, let me go ahead and share with you my screen so we can get this thing started. Those of you who are new to Earnings Beats, I always like to start off over here at our website. You can come over. We are running our fall special. So we announced that on Saturday, and it's good for, well, it was good for 2 weeks. So it's good through Saturday, November 27th. This is honestly the best deal we've ever offered, mostly because we have never offered huge discounts on extended periods of time. I think in the past, all of our specials have always been 1-year specials, but we wanted to reward those of you who have supported us here over the last couple of years. Anybody who would like to commit to a longer period will save even more. So you can see our 1-year deal will get you 2 bonus months. 2-year deal will get you 6 bonus months. And if you decide to go out 3 years, you'll get a whole bonus year, an additional 12 months for free. So you can see that definitely lowers the monthly rate going out. And to compare, normally if you become a trial member with us and then you go to a month-to-month, our normal monthly rate's $147 a month. So you can see the savings on the screen there based on extending out further and further. So I wanted to point that out for everyone. So if you are unaware, I want to make sure you are aware that for the next 2 weeks, we have a really good fall special. So if you've been on the fence, you're thinking about trying our service, now's a great time to sign up for the trial, the 30-day trial, because it's free. So for the next couple of weeks while this deal's running, you can kind of see what the service is all about, see if you like it. And if you do, you can take advantage of this up until Saturday, November 27th. So I think that's cool. And the other thing is, if you sign up for a 30-day trial, you'll get the rest of your trial period. So if, let's say in 10 days, you decide to extend, well, the extension would go from the end of your trial period. It would not, you wouldn't lose the other 20 days of your trial. So I just wanted to be clear on that. Going down further on the page, though, if you'd just like to learn a little bit more about us and you want to kind of get a feel for what we do and how we approach the market, I think subscribing to our free Earnings Beats Digest makes a lot of sense. It's a free newsletter delivered 3 times a week, Mondays, Wednesdays, and Fridays, normally out by 8:30 or so in the morning, sometimes a little bit later. But for the most part, we're trying to get that out before the market opens. And it's normally a couple of paragraphs in one chart. So it's an easy, quick read and focuses on the things that are important to us. So, we're going to be looking a lot at relative strength. We're going to look at candlesticks. We're going to be looking at earnings, talking a lot about earnings, how we design a portfolio. We actually had an article in today talking about one of the stocks in our portfolio that we had added last week. And so it's really geared toward helping folks reach their financial goals, whatever those are. So check out that free Earnings Beats Digest newsletter. By the way, no credit card required. You can unsubscribe at any time. No questions asked. We realize, hey, we're not for everybody. No one out there is for everybody. But I do think we offer a lot of really good educational material. And hopefully you'll check us out either through the free trial or the free newsletter or this free trial, and potentially taking advantage of our fall special. All right, let's take a look at what happened at the end of last week. You can see the Dow Jones finished up 179 points on Friday. S&P up 33.5. NASDAQ up 156. Mid caps up 9. Small caps down 1.5 points. So you can see on a relative basis, mid caps and small caps struggled a little bit. But overall, the action last week, yes, we had a hotter than expected inflation, no doubt about it. We saw a lot of the growth stocks getting hit to the downside, but those growth stocks came back toward the end of the week. So a lot of those companies that were getting hit, and you would expect growth stocks to get hit. If the market's truly fearful of inflation, growth stocks are going to be the first to go because all of those future earnings aren't worth as much. So if your valuation is based on future earnings and you've got inflation eating away at future earnings, growth stocks are going to get hit. So one of the ways to look to see whether or not the stock market is really worried about inflation, one thing is watching those growth stocks and how they perform relative to the value stocks. Value stocks should crush growth stocks if the stock market is truly worried about inflation. So keep all that in mind. Looking at the sectors, we had communication services starting to bounce back. I've said recently, and I believe this is going to hold this support level on the XLC around 79. You can see we topped up about 87 back at the beginning of September. This group had been leading. It's just as it's passing the baton. That's what really is going on in secular bull markets. You have groups that lead, and then they pass the baton to another sector. Rather than everything going down, which is what happens in a bear market, in a bull market, the baton just gets passed. So leadership just rotates. And it frustrates the bears because the overall market doesn't come down. You know, we might have a little profit taking, lose a few percent here or there, or maybe even 5 to 10% once in a while, but you don't get those 20% bear markets as long as money continues to rotate into various areas of the market. So communication services looks to me like it might be ready to start bouncing back here. It's been an underachiever for the last 2.5 months. I think that could be changing. Technology is not an underachiever. We've been seeing that move. Industrials have started to move. I love that breakout. I've talked a lot about industrials, and that's not going to stop today. I'm going to talk about it some more in just a few minutes. Materials also have broken out. I'm not a big fan of materials and energy because I think the dollar goes higher. But, you know, when we get breakouts, I'm fine from a short-term perspective looking for opportunities in areas that I may not believe are going to be leaders for 6 months down the road. But for the next few weeks, yeah, I mean, materials have been looking really good, trending higher above the 20-day. They continue to look strong. I would just make sure I have my stops in play in the event they start to roll back over. I'd be more lenient maybe with stocks in the consumer discretionary, technology, and communication services area, and now industrials with that breakout. So materials still look fine. I mean, don't misunderstand me. I'm fine trading anything. I think every area of the market in a secular bull market is going to go higher. I think just about everything's going to go higher, but some things are going to go up a lot higher, a lot more higher. Is that a word? Can I use that from a relative strength perspective? So anyway, materials also had a good day. See, those were the 4 leaders. Energy lagged, was down about 0.25%. And this is what I was talking about earlier about rolling over. You can see, you know, the technology area moving up, industrials moving up, materials moving up, even looking at the major indices. See how we've been moving up? Well, for the last 4 weeks or so, energy is not. Energy has been going sideways. So we're seeing underperformance there now over the past month or so. All right, moving on to the 10-year Treasury yield. Let me get you an update here. Talk a little bit about some economic reports coming out. So earlier this morning, about 30, 40 minutes ago, we had the November Empire State Manufacturing Index report come out. The expectation there was 22.7. October was 19.8. So we were expecting it to jump up to 22.7. It jumped up to 30.9. So very, very strong in terms of manufacturing. I think the industrials, I'm telling you, we're starting to see now some fundamental reports. And this is not a fundamental report, an economic report that goes back 2 or 3 months either. This is the November Empire State. So it's more up to date than some of the others, but we got a nice move there. Later this week, tomorrow, we're going to have a number of economic reports out this week. But tomorrow we have retail sales, industrial production and capacity utilization, also the housing market index. Wednesday, housing starts and building permits. Thursday, initial jobless claims, Philadelphia Fed manufacturing index, leading indicators. And then we slow down, nothing on Friday as we head into the weekend. But next few days, we're going to get some economic reports. So we want to watch the bond market and see what's going on here. If the 10-year Treasury yield, if we get strong reports and we see the 10-year Treasury yield moving up, I think, first of all, that's great for the stock market because it's telling us money's rotating out of the bond market, which is almost always a good thing for stocks. But that money is probably going to rotate more into the financials and in the industrials if yields are rising. If yields aren't rising, they're flat or they're moving lower, then you can probably expect the technology, consumer discretionary, and maybe communication services, those areas picking up. So we'll just see. Now, if we do go higher, I'm not expecting a huge sell-off in growth stocks. I mean, it's always, difficult to say what the market's going to do in the short term. I mean, many of these growth stocks have been absolutely exploding to the upside. Stocks like NVIDIA and Advanced Micro, AMD. Some of these big growers have been exploding to the upside. Of course, they're going to get profit taking at some point. They're not just going to go straight up. But overall, money is rotating toward that side of the market, which I think is bullish. All right, let's move on and talk a little bit about the sector summary. So this was last week. So you can see materials having a strong week last week. Healthcare, there's your industrials moving up. So industrials, which have been lagging for a while, starting to show more signs. We got that absolute breakout. And this right here shows you that on a relative basis, industrials performed pretty well last week. Consumer discretionary, passing the baton. Consumer discretionary just had a huge move. We saw this group go from about, 185 on a breakout at about 185, 186, ran up close to 210, might have been above 210, I can't recall. But now it came back last week to 203. It's still way up from where it broke out, but it's passed the baton. Now we have something else leading. We got materials going. We got industrial starting to pick up, even healthcare, which has been lagging. So that's the rotation I think is important to watch. The XLI I wanted to talk about specifically because after this move up, you think when you're looking at the relative strength lines, you think, oh my gosh, industrial's been horrible. In fact, let me get rid of this accumulation distribution. Let's take a look at the relative strength down here. All right. So this is a 3-year weekly chart. And you look at this and you say, my gosh, industrials are horrible. Look at all the money it's losing. Well, it's not losing money. It's just losing its opportunity costs. It's relative to the S&P 500. We topped on the XLI at 105, and we went in this 100 or maybe down to about 98, 97. So we were in this range where we just traded back and forth. We sideways consolidated off of an uptrend. That's a bullish continuation pattern. But while it's resting, essentially what it's doing, and you can see from May through May, 2020 through 2021, we had a year where industrials were leading, coming out of the pandemic. Now we've pulled back, but it's because we're sideways consolidating. You're not going to lead if the market's going up and that area sideways consolidates, but we just made a breakout. So I'm looking for this to start to turn back up again. And so it's really important to, pay attention. The reason I say that, not only are we seeing the breakout overall in industrials, but look at the, let me see if I can get this other chart up here for you. Look at the transports. Transports just broke out after essentially sideways consolidating, testing that 50-week moving average. It's been up almost every week now. Well, it has been up every week for the last 5 weeks. Or prior to last week, it was up for the last 5 weeks, the previous 5 weeks. So transports, that's a big part of industrials. Transports have broken out. And we can't lose sight of other areas within industrials. I'm looking at something like aerospace. Now, aerospace tumbled going into the pandemic. You can see right here back in 2019 into early 2020, aerospace had already gone to about over a 2-year relative low. The pandemic was just throwing kerosene on the fire. And at that point, we got down to ridiculous lows in aerospace, but we've been bouncing back. Now we haven't been showing relative strength, but as the market's been climbing off of that low in March, or really this low right here, this relative low in May, we've actually held our own in aerospace. So we think of aerospace as being a horrible group, which it has been, but it's not losing ground to the S&P 500. And over the weekend, there were a number of orders for Boeing and Airbus and so forth. And I saw this morning, well, let's take a look at Boeing, but Boeing got back up above both moving averages, and it did so with really nice volume at the beginning, or I guess that was the tail end of the previous week. That would have been on November 5th. Last week consolidated above the moving averages. And this morning, I'm going to show you the what Boeing is doing on this weekend news. It's up $7 this morning, $227.90. So let's go back and take a look here, $227.90. We're going to be right back up here, not far from what I consider to be a pretty significant area of resistance. So the reason I bring this up, I tend to stick with leading stocks, and that's what I tend to trade mostly. But we also want to be watching for money rotating. I mean, I love NVIDIA, I love AMD, but my gosh, these stocks, look at how much they've run. So do you want to leave, a lot of your money parked in NVIDIA after a run from 200 to 320? Or do you want to be watching for other stocks that could begin to show leadership, like Boeing? Now, again, Boeing hasn't done it yet. This is a little premature, but we still have to be watching. We have to continue to watch for it. We don't want to wait until Boeing gets up to 300 and then say, oh, yeah, Boeing looks good. Well, from 200 to 300 is 50% move. Yeah, it obviously is going to look good at that point. We want to start seeing these stocks as they're making their way up. So today on a stock like Boeing, I'm going to be watching the volume. I'm going to see if we can take out key levels. And if we do pull back after a nice open, I want to see if that 20-day and 50-day hold. Because right now it's starting to show good signs, but look at what's happened in the past with Boeing. We get through these moving averages, we can't hold them, and we roll back over. But again, I want to go back to that aerospace chart, because on a relative basis, we're holding relative support. Now, if this were to break down here, then I would be more concerned about stocks like Boeing. So anyway, just wanted to, focus. We want to focus on what's working and what's winning and what's leading, but we don't want to completely ignore other areas that may be starting to show signs of leading. Especially, again, you get into NVIDIA. NVIDIA looks great, but could it pull back to, 260? Maybe we'll pull up that chart. Now, let me pull it up on a daily. It's at 300. Well, the 20-day moving average is at 270. So that would be a no-brainer. I mean, no matter what, what the chart looks like, I mean, pulling back and hitting the 20-day, that's just a normal test in an uptrending stock many times. Look at how stretched the PPO is. I mean, look out over the last year. This is the highest that PPO has been. So we're clearly overbought. So the question is, do we want to, be thinking about some other areas that are just starting to break out? Look at industrials just making a breakout. So it doesn't have to be Boeing. It could be a stock like I mentioned in one of my articles over the weekend, CNHI. Look at this industrial, sideways consolidating, just broke out above the June high. Volume strong. Now, again, is this a guarantee of it going higher? No, but this is one that's showing better technical attributes on the chart. So this is one that I'd be interested in now. I don't own CNHI, but this is one that I would be considering. And realizing that if it did pull back, the 20-day moving average and gap support are two areas likely to hold, which would be down, around 1750, 1775 in that area. So if I got in here, what I might do is maybe get in half. If it did pull back, get back into the 17s, I might, at that point, get into my other half and then watch the gap support maybe around 1750. But that would be a way to maybe trade the CNHI, assuming industrials keep going higher and a stock like CNHI begins to lead again after breaking out on an absolute basis. All right, what else do we have here? I tell you, I want to look at a scanning strategy here with you. So what I did is I looked at the stocks that had strong scooters recently, and now they've pulled back. So the scooter stock charts technical rank, SCTR. All it is really a relative strength formula, comparing stock, large cap stocks to other large cap stocks, small cap stocks to other small cap stocks. So if you've got a scooter at, up near 100, the highest you can get is 99.9. If you're in that upper 90 range, you are one of the strongest stocks based on the formula used to calculate the scooters. When you start to drop back down, I use this range 65 to 75. You're still, above the 50 percentile. So you're still among the leaders, but you've pulled back a little bit. You're no longer considered one of the top leaders. And that might be an opportunity. You might have so the way I set the scan up is that I wanted stocks with scooter scores above 95 30 days ago that now have scooters between 65 and 75. And I looked on the New York Stock Exchange, looked on the NASDAQ, so it could be on either one of these. I set the minimum volume, 50-day average volume at 250,000. And then, of course, wanted to make sure it's a stock, but it also pick up ETFs. And this is what was returned. When I ran that, this is what was returned, 11. So it's a very manageable list. The other thing that this kind of points out to me, you can look at this and see, the areas of the market maybe that have not been as strong. So remember, I was talking about energy looking like it's going to roll over. Well, 3 of the stocks here, these 3 stocks are energy stocks. And so as energy kind of rolls over, it makes sense that some of these energy names that used to be 95 and above have now fallen back. Well, if you're an energy fan, here you go. This might be an opportunity. If you really like energy, I could be wrong. Maybe energy continues to lead for the next year or two. If you disagree with me and you like energy, this would be a great scan to pick up a couple energy stocks. So I look at something like OXY. Let's go over here and pull up OXY. This is Occidental Petroleum. Had gone it's been going sideways for a while. Had a little bit of a negative divergence up here on this high. See the higher price, the lower PPO. And now it's pulled back close to the recent support level, just below the breakout level, and now down near its 50-day moving average. So this is a stock that probably presents, it definitely presents less risk than it did a month ago. A month ago, it was breaking out. Like I said, that scooter score would have been up above 95. I'll get rid of this AD line. Let's put the scooter in here. And so there's your scooter. 1 month ago, up around, close to 100, 95. That was the scan. That's what we're looking for. And here's the scooter pulling back. So is this an opportunity? Well, it's up to each individual. If you like energy and you're looking for energy plays, I think Occidental Petroleum, having pulled back $4 from 36 back to 32, now closer to the 50-day. Yeah, I think this one looks pretty interesting. You look at a stock like this and you see this straight up move, and it kind of reminds me of that NVIDIA chart I showed you. And Occidental Petroleum, after doing that, went sideways for a period of time. I don't know if that's what NVIDIA is going to do, but it's okay if it does. It's okay to go sideways for a while. That's a continuation pattern. So again, we want to keep our eyes open for potential opportunities. So some of the other stocks on here, I'm not going to go over. I'm going to get into some of the earnings reports, but I did just want to kind of point these out. So, if there's another area, like there was one consumer discretionary stock, it's in gambling, which has not been one of the best areas, but Red Rock Resorts had a scooter 1 month ago over 95. So considering that the group hasn't been good, that has definitely been a leader. So maybe this is, presenting an opportunity. So if I pull up RRR, one last one real quick, we've pulled back. Look at the breakout level right here at 47.5. We pulled back to, looks like 47 and change. Now we've got to get through the 20 days. So I think we're trapped right now between 47.5 and maybe about 52.5. Let's see which way breaks. But the scan points us out to a stock that a month ago had its scooter at 95, and you can see it's been high for a long time. But this weakness, and maybe the volume scares you, move below the 50-day, which is fine. In my opinion, we haven't lost major price support. So I'd be more interested in seeing whether or not this recent low holds. All right, let's move on to earnings spotlight. So first I want to just point out Oatly, O-T-L-Y. Now, Oatly is in the food processing area. And look at what the stock's been doing, going from 29 down to 11 over the last 5 months. Now, I don't know, how you all approach the market, but for me, when I see a stock doing this and I see the AD line going down and I see all these relative strength lines going down, first thing I think of is Wall Street is trashing the company. Wall Street doesn't care about the company. And if Wall Street doesn't care about the company, there's probably a reason. Because if this company was likely to move higher, trust me, Wall Street wants to make money. They would be in the stock. This stock would be showing relative strength. Instead, it's showing relative weakness. So they came out with their earnings this morning, and they reported better than expected results on the bottom line anyway. 7-cent loss. The market was expecting a 10-cent loss. But let's look at the reaction and what's happened here. OTLY down 19% today. So while some, you get a lot of folks that are value. I'm not a value investor. I am definitely a growth investor. I trade momentum. I do not want to look for bottoms. I generally do not want to try to call a bottom. It's okay to be watching for bottoms and see some confirming action begin to tell you that the bottom is in. But to try to call a bottom when it's trading at a low like this, there's no way I'm going to do that. So, and this is a reason why. And I don't know what the revenues were, and I don't know what they did with guidance. And like I said, bottom line, they did beat, but the market is trashing the company here in pre-market action, down almost 19%. So this is why I like to follow relative strength, especially going into earnings reports. I can't usually tell you whether or not a stock is going to go up or down, but a lot of times it will give you an indication of perhaps a poor report coming out. And once again, I don't know what the revenues were here in the guidance, but I got to believe that they didn't beat everywhere and raise guidance. I don't believe we'd see that kind of reaction. Another company on the earnings side, let's see, how about, one that reported strong. Let me just show you this first. TWKS is up, or was up 7%. Now it's up 5.7%. So it's getting a nice reaction. Here, I just see a sideways, trading range. I think if you can get back, you got to get through that close at about 34 and change to really start getting this thing moving. So until we see that, probably going to be difficult. Probably just more sideways consolidation. But maybe with earnings, we get this gap up and make the breakout today. We'll see. Coming up later today, Advanced Auto Parts will be reporting after the bell. Later this week, so we do have, it's almost like an Indian summer. You go through these earnings reports, all of a sudden everything seems to dry up. And then all of a sudden you got big companies coming back out again. So you got Walmart, Home Depot, NetEase, all reporting on Tuesday, Wednesday, NVIDIA, Cisco. Now, NVIDIA, I will be shocked if they disappoint. Shocked based on the way they're trading heading into their earnings report. But it could be a buy on rumor, sell on news. They may blow out the numbers, gap up, and then the run could be over for a while. Got to be aware of that. Anyway, NVIDIA, Cisco, Lowe's, Target, TJX, Baidu, all will be reporting on Wednesday. Thursday, Alibaba, Intuit, Applied Materials, Palo Alto Networks, Ross Stores, Williams-Sonoma, Macy's. Macy's been on a nice run. All those companies will be reporting. So we do have a lot of big companies reporting later this week. All right, let's wrap this up with the 3 you must see. I'm going to start off with 3 companies. Well, I'm not going to start off. I'm going to do this with 3 companies that showed their scooter scores dropping significantly on Friday. So Expedia pulled back, but this stock was over 190. It's back near this gap support. I think current price down to that 20-day moving average is an interesting entry point for Expedia. Next up, NTAP, Network Appliance. We pulled back on Friday, but I'm just seeing sideways consolidation. I think 87 down to 85 would be the best entry point on Network Appliance. It was at 95 recently. Last stock, SYNH. This is Syneos Health. Big breakout, good size volume, big selling on Friday, went all the way down to 92.50, came back up though and held the 20-day. This is an area where I think the stock needs to turn. All right, it is 9:30. Market is opening. Appreciate you tuning in. We do this here at Earnings Beats Mondays and Wednesdays. Of course, on Tuesdays and Thursdays, same time, 9 a.m. Eastern, go over to Stock Charts and hit the Stock Charts TV link at 9 a.m. and you'll get Trading Places live on Thursdays or Tuesdays and Thursdays. So we do the show. I do the show 4 times a week, Mondays through Thursdays. Just 2 days here at Earnings Beats, 2 days over at Stock Charts. So make sure you check that out. Market getting off to a pretty good start at this point. Got the NASDAQ up 156, S&P up 10, Dow up 105. Let's get an update just to see if it changes the market movers. Yeah, I don't know. Let's see. Yeah. See, I wanted to see Boeing, just see what Boeing is doing, and then we'll wrap it up. Yeah, Boeing up $6, so we'll see whether or not we can get through that 230 level. Anyway, that's the way I see it starting out the week. I hope everybody has a great day, and be back tomorrow over at Stock Charts TV for your next Trading Places Live. Have a great day, everybody. Happy trading.